first start working with a client, we'll do, I just call it a 360 review of all their operations and everything they have in place. And one area we spend our time on immediately is working on insurance coverages, because policies are going to be written so that they're also covering us. So we want to make sure that homeowners associations have the right insurance. And it's amazing to me how many times we come into situations where they had inadequate insurance. Crime insurance is one area that I have seen the most problems. Typically it's written on a policy form that is a employee theft policy. If you read the definitions of what employee is, and I know people are always reading insurance policies and definitions, it's exciting reading, but if you actually go in and look at what defines an employee, they typically have to be paid. Board members aren't paid. The management company is not paid as an employee. And I have an association we took over where they had no coverage because of that reason. The policy should also specifically have a provision to include the management company. If the management company is not specifically mentioned as being covered, they're not going to be covered under the policy. And same situation with them, the management company wasn't covered. Unfortunately for them, their management company before us stole about $130,000 of their funds. And the association has no recourse except for back to the management company itself. Because the policy they've been paying for was essentially worthless. The other thing that we saw in that policy was the crime coverage provided coverage for money. And again, reading the definitions, money was physical paper or coin, minted money. It wasn't funds on deposit in a bank, which I never realized that could not be money, but it is not money according to their definition of the policy. So again, they had no coverage because most associations, the money goes directly into the bank through the assessments, and people aren't collecting cash. That was all that their policy would cover. So all around was just a very bad policy. Board had no idea. The agent didn't realize all the problems they had with this. It wasn't until we were looking at it and explaining to them, these are the shortcomings of the insurance, so the first time they realized that they had the wrong insurance policy. And we see that too with the D&O policy. So directors and officers policy is going to cover the board of directors and also management company for decisions that they're making and how they're interacting with homeowners. And what we will see as the number one exclusion, and we think it's important not to exclude, is civil rights. So what that would cover is somebody makes a claim under the Fair Housing Act, which doesn't take much to make a claim under the Fair Housing Act, and there are a lot of protected classes in this country. Any one instance could file a claim. There would be absolutely no coverage under the policy for that. We see that as being one of the largest sources of potential claims in the homeowner association just because it involves real estate. And for that reason alone, a D&O policy, you've got to have one that covers civil rights. And if it doesn't, you need to get a policy that does. On the property coverage side, for the most part, we don't see too many issues with that because they were written with the idea of covering the homeowner association and their special policy forms for HOAs. So they're pretty well done, but we occasionally will still see some issues that will trip up communities. For the most part, sewer or sump pump failure is not going to be covered under a policy unless they add an endorsement to it. The policy to add that in. A lot of times it's going to be under a separate limit, meaning they might provide $15,000 of coverage. Well, if you have one home or maybe two homes tied, a twin home tied together, $15,000 might be enough. But if you have 4 or 6 or 8 homes that all have a lower level that's shared where water could flow between one and the other, a sewer backup could potentially damage all those units. And now you could be talking about a claim that's $80,000 or $100,000. And we worked with a community that where we came in after that, and that's exactly what happened to them. And they had $15,000 in coverage, and then now they had $65,000 that was uncovered. And of course, those individual homeowners were responsible for that, but some of them didn't even have sewer backup coverage under HO6 policy as well, and so they had to pay $20,000 out of pocket. That's a lot of money to have to be able to come up with. And so understanding what the limits are in some of those special endorsements. We also will see that with blanket coverage. Blanket coverage is easy coverage. Most policies include it, and that means each building in a community will have its own separate limit. And blanket coverage will allow all of the buildings to be under one, and then they'll use that higher limit. So any one building that is damaged can use that higher limit. So if you have 15 buildings, each valued at $1 million, you will have 15 million in coverage. If you have 1.2 million of damage to one building, if you don't have blanket coverage, you'll run out of insurance at $1 million. If you have blanket coverage, well, you could apply the whole 15 million to that one building, and you are whole. Another area that associations will run into a problem is with the hail wind deductible. We've seen that become much more prevalent just because of the claims being paid out on those. And I think it's here to stay. We've seen some insurance companies vacillate back and forth, but that's going to be 1% of the building value, or 2% of the building value is typically how they define it. So if the building is $1 million, there's going to be a $10,000 deductible per building. Well, the reason why they apply this to hail and wind is because those typically affect many buildings under one claim. And so each one of them will have a $10,000 if you got 15 buildings. Well, now you have a $150,000 deductible. It isn't, in our mind, it's not anything really to get too excited about, because the association has the insurance deductible policy. You have the right to assess that deductible back to those homeowners. The HO6 policies, and the vast majority of people will have an HO6 policy, will pick up that coverage without any issue at all. And so it may look like a $150,000 liability hanging there, but when you turn around and bill it back to all the individual HO6s, you're going to have $500 to $1,000 deductibles on those HO6 policies. And so you're going to have a much lower threshold to cover. And we usually recommend at that point that the association pay that $500 or $1,000 anyway, because you're getting free roofs out of this deal, and your reserve, so you can use some reserve dollars to pay for that deductible for that. And so in the end, it isn't as bad as it might look with having a 1 or 2% hail deductible. As a result of that, more and more insurance companies are putting into their policy language specific language that says we will not pay for damages unless it has sustained direct physical loss, meaning the hailstone had to have hit that specific piece of siding before we will replace it. If it didn't, and it no longer matches the new stuff, we don't care. And so what's going to happen is associations are going to have to pay for that out of pocket. Most associations have no idea that this policy has been, or this endorsement has been added to their policy. And it's going to be an issue for more and more as we continue to have hailstorms and as buildings age, because in 10 or 15, 20 years, siding becomes unavailable. Shingles don't match. Now you've got a problem.